Now to our overtime exclusive. Double Line Capital's Jeffrey Gundlach is with us live to react to what the Fed just said and what the Fed just did. Jeffrey, welcome back. It's great to have you on the new program.
Yeah, nice to be on your new show, Scott. Congratulations.
Thanks so much. So you heard the Fed. They've spoken. It's your turn. What do you think?
Well, the Fed follows the two-year Treasury, and I've been saying this for years and years. I don't know if your viewers can see this chart here, but it's a chart of the Fed funds rate in red and the two-year Treasury in blue. And so look what the two-year Treasury in blue did starting fourth quarter of last year. It went up by, guess what, 175 basis points. So what did the Fed do today? They said they're going to raise Fed funds by 175 basis points. And so that's just them following again. And they're way behind. I was listening to this prior segment. You know, here's one more chart I'm going to give you. The blue line is wage growth, wages and salaries, and the employment cost index. The red line is Fed funds. The blue line is the wage growth. If you look carefully at that chart, the Fed follows wage growth historically. That chart goes back to 1985. This time, wage growth has exploded higher, and the Fed has been behind the curve. And I thought that Jay Powell did an okay job today. He was a little bit of an equivocator. I thought it was better than the last time we were in this sort of a predicament, which was in the fourth quarter of 2018, when the Fed was raising rates and doing quantitative tightening. I think the stock market was way oversold. I think commodities got way overbought. And so I'm not surprised that we've had relative market stability into this Fed decision. And I expect that the oversold will continue to work its way higher. In other words, stocks will go higher. I saw your question about will we be higher on the S&P at the next meeting. I think probably we will be over that time period. The stock market was very happy. I think we'll be happy higher because we're oversold. And we didn't get the 50, which the market was fearing, I think, although I thought the probability of that was awfully low. And we didn't get any clarity on reducing the balance sheet. And I think that the market kind of likes the fact that the party's going on. They sort of like the fact that the Fed is behind the curve for now, even though it means that they may have to accelerate and get in front of the curve. For now, rates are still really accommodative, and the Fed didn't do the 50, and they're not shrinking the balance sheet yet. I think the market will roll over once the Fed raises rates a couple more times, and if they start the roll-off, which he sort of alluded to being the base case at the next meeting, I think that's when you've got the double whammy. At least he didn't pull the 2018 thing of autopilot. He tried to have some flexibility. He gave the impression of autopilot, but he didn't say it, and I think he even said the word flexible or nimble or something like that. And so the market likes that over this oversold.